It's not that often that we get such a big week in the market. Big tech earnings, FOMC, QRA, and non-farms is just a few of the things that will bring the volatility. And so, as April draws to a close, this means we need to start looking at the data to see what normally comes next. What are the big trends leading into May during an election year? What sectors should we be looking at, and why did the Russell 2000 sell off so much this month? Today, we're going to talk about that and the latest charts moving forward, and why sell in May and go away may actually be the worst thing for your portfolio in 2024. We're also going to talk about GDP, inflation, and where we stand with Gamma. Are the bulls back? Or should we be concerned? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe. We're trying to get 10,000 subscribers in May, and hit the notification bell. That also really helps me out. Like this video, let's get into it. Quite the upbeat day under the hood, even if the S&P 500 didn't quite show the day we had. Very green in most sectors, except financials. They were red, except for those coming off earnings or leading up into earnings. Look at American Express, look at PayPal. Now the mega caps were probably the most mixed bunch out of everything. Tesla was up 15%, Apple was up 2.48%. Again, Apple running into its earnings, Tesla coming off its earnings. Nvidia was flat, Microsoft was down 1%, and Meta and Google really led selling in the comm services sector. Meta on its earnings, as well as Google giving some back after that 10% gain on Friday. But looking at all of the sectors, guys, very upbeat action. Discretionary won the most, but it was green across the board. Almost every sector beat the SPY, and even those that didn't, like semiconductors, was still in positive territory. Same with healthcare and staples. XLF financials did lose a hair, same with software, regional banks too, and then XLC led by Meta and Google, although not indicative of what's really going on in the sector as a whole. All in all, it was a very mixed day. There was no real leader. Some of the mega caps gained, some didn't, but the cyclical economy did do really well. But let's hop on the charts and talk about everything. Now, before we dive into the technicals, have a look here. The S&P 500 and Nasdaq 100 up 0.32, 0.36%. The RSP up 0.7%, so very upbeat day in the market. That's a pretty big gain for the RSP. Mid caps and, across the board, it was broad-based gains. Look at mid caps, small caps, IWM, SPYG, SPYV, so growth and value gained as a result. So it was definitely a broad-based market move. Part of the reason why we actually saw upbeat markets actually had to do with bonds. Bonds actually caught a bid. That means yields went lower. The second yields go lower, it's going to support equities, particularly cyclical equities, smaller cap equities, and mid cap equities. And that's why we saw, the RSP rally today. And we saw the same moves across investment grade bonds, government bonds, high yield bonds, corporate bonds. We also saw that there's a lot of tensions easing on the geopolitical front, and that's why oil was down 1.4%. The DXY, the dollar, was down another 0.5 percentage point today. And then gold and silver just lost a hair. But let's actually have a look at the S&P 500. This is a chart we've been following for the last week. If you haven't watched the weekend video as to what these lines mean, go ahead, go watch the weekend video. I discuss everything in there, and you can see we are tracking exactly as we should. Here, this zone right here, 49.20 to 5,000, I said that this is going to be our buy zone, and we have since rallied. Now, this rally is very healthy because a couple of things. Number one, we put in a low, we then go make a high, breaking these key highs right here. We then go put in a higher low relative to this low, and then rally from there and put in another higher high. Now, the next line in the flag is going to be this 150 area. That's really what the markets want to go attack. This 150 area is important because it was the open of this massive down candle we saw here, and then it opens up these levels for us to go and take as new highs. But 150 is the next level, the next line in the sand that we need to go attack. Now let's actually look at intraday trade on the 5-minute chart. So if we just zoom out, you can actually see we did gap up, and then we had quite a bit of volatility, and then we sort of didn't make a higher high on the day, and then we came all the way down, and then at 3 o'clock the 0 DTE hedges started rolling off, and that was all upbeat action. Now you may look at this and say, hey, this is quite volatile action, but when you put it into perspective, it's just a standard day in positive gamma, very compressed range, buy dips, sell rips, and that's exactly what the market did. What you do have to take into consideration though is that we are above the close of Friday, and that is always a bullish sign. But going back to the daily chart, we can see that with the gap, it means that bulls did come in a big way, and looking at candle location and structure, we did close in the top 1/3, with a massive wick at the bottom, and that is indicative of bull support. Bulls gapped up, held the line, and that's really what you want to see, and that probably is indicative of higher price action in the future. Maybe we do trade a little bit sideways, but it does look like risk is skewed to the upside, and I've been saying that since this level right here. I told you guys that this is the exact place that you should be buying, and this is exactly where we bought. Now I'll show you what I mean. This is exactly what I mean. Here on April 15th, this tweet right here, I said the likely path is that we sell off to around the 5,000 area at or near April OPEX, and then we rocket. Remember, we're only looking for opportunities to add long exposure on short-term weakness. The trend is up. I said that on April 15th, and that's exactly what happened. That tweet was given on this candle right here, April 15th. We then made our way all the way to the 19th April, which was Friday OPEX, at or around the 5,000 area. This was the bottom, and then we rallied all the way ever since. So a great dip buying opportunity if you got in. And what also makes this area very constructive for further price action is that if we actually are to measure from the peak to trough, we are actually just above the 50% fib. Normally this acts as very strong resistance. This is now sort of acting like support. And if we do see follow through, that will continue to act as a great resistance turn support level. So by Friday, what I really want to see is actually a movement here to the 5150 area, especially as we leave the window of weakness and make our way in a positive gamma environment. We want to be buyers of dips, sellers of rips all the way to this 5100 area. What we really do want to see is the core gamma resistance move up to this 5200 area. If we see it move up to 5200, that is going to be your signal to go along to the 5200 area into the May OPEX. If we do pull back, I would look at very, very key support levels being this level right here, 5070, 5050. Those are the two levels I would probably look to add exposure for this continued move to the upside at 5200 and ultimately 5020, 5000. I think there is definitely risk with all of the data and earnings we have this week. However, earnings has been a tailwind for equities. What really matters is QRA, the FOMC, and a couple of the data points, particularly NFP. That could bring the volatility. If it does, let's say we do get a knee-jerk downside reaction like we did here, I would really look to 5020 and this 5,000 level as support. I don't think we're actually going to break those. I think we have put in an interim bottom. I would add exposure here if we do get a second opportunity. Don't think we are. I think we're probably going to go to the 5075, 5050 area at most, and then rally from there all the way to the 5150 area. If things do go our way, the core gamma resistance moves up to 5200, and then Bob's your uncle. We go all the way to 5200, potentially at that point, new all-time highs. So guys, looking at sentiment, this is the weekly sentiment poll. I thought I'd mix it up this week. I thought I'd get your sentiment on how you think Powell is going to come out in this week's FOMC. 31% of you said Powell's going to come out dovish. 69% of you said hawkish, and that is a very big number right there. And so it's safe to say that the sentiment is hawkish. And to be honest, I think that Powell is probably going to come in neutral, but if he is going to lean to one side, he probably is going to lean hawkish. Given the data that we've seen, I think being dovish would probably be a mistake. But this right here is just sentiment. It doesn't really tell us much of anything. What does tell us a lot is actually these type of stats. And this is the S&P 500 after the first negative month following a turn of the year hat trick. That is defined as a positive December, January, and February. So pretty much we have a positive 3-month period to the start of the year, a negative month. What are the returns for the rest of the year? And we could see here that in April, we are down 2.93% for the month. And these are the returns we normally do expect. 1 month later, average return 2.54%, 21 wins, 4 losses. 3 months later, 20 wins, 5 losses, 4.1% average return. 6 months later, 22 wins, 3 losses, 8.58% return. And what's very, very interesting is that after that first negative month, there isn't a single negative max drawdown, which pretty much tells us that the first negative month we get in a positive turn of the year hat trick is normally a buy the dip opportunity, and we normally get extremely outsized returns 3 months, 6 months later relative to the index average. The S&P 500 6 months on normally only returns about 4.4%. So to see 6 months return closer to 8.5% does tell us that when we've had a positive turn of the year hat trick and a negative month, we do want to buy that dip and look for higher price action. And that probably means we do go higher this year. Is it a certainty? Definitely not, but the probabilities are stacked towards the bulls. Let's switch gears and talk about earnings. We had a couple of big names report earnings here: SoFi, Domino's, Paramount, NXPI, Logitech as well. And we're going to look at SoFi just because a lot of fintech bulls love the stock on Twitter. We're going to go quickly over it. And then the big dogs start reporting tomorrow: Amazon, Supermicro, AMD, Starbucks. A very big week of earnings here, guys. But let's talk about SoFi. Now, a double beat here for SoFi. Reported 2 cents on EPS. The street was expecting 1 cent on $580 million worth of revenue. 555 was what the street was expecting. So it was a double beat here and raised. They raised guidance. They guided for 829 cents for 2024 on revenues of 2.43 billion. The street was expecting 2.37, so it was a beat and raise. However, the stock was down 3.9% in the pre-market. This segment is recorded pre-market on pretty much the street not knowing what it wants. I don't know why this result was down nearly 4% in the pre-market. Maybe there's something I missed in the earnings, but I thought it was very, very good. No idea why the stock was down. They actually paid down a substantial amount of their debt as well. They had only $2.4 billion on their balance sheet versus $5.9 billion worth of debt last time. No idea why we saw this figure in the pre-market, but it might be different at market close. But great earnings nonetheless from SoFi. So where do we stand on the earnings front? The S&P 500 has reported 5.6% earnings growth. At the start of earnings season, it was 3.5%, excluding energy. That's 8.5% growth, and then 8.7% excluding BMY's one-time $12 billion charge related to the acquisition of Karuna Therapeutics. All in all, earnings are doing really, really good. And the same is true here for the revenue front. 3.8% revenue growth for the S&P 500. At the start of earnings season, it was 3.5%. Excluding energy, we're looking at a 4.4% growth. And as you can see, Q1 EPS is tracking slightly above consensus. Earnings is looking very, very good. And that's why if we do get a pullback, you do want to buy those dips, because we probably are going higher because the fundamental picture is looking very good. But what are the actual stats of those beating and missing expectations? 228 companies have reported. Percentage of companies beating on EPS, 72%. That's a very good number. Percentage with sales beats or revenue beats, 58%. That's actually below the historical average of about 68%. And then EPS and sales beats, 49%. And again, the historical average is about 68-69%. So well below the historical average, but we'll see where this ends up after this week. All in all, when you do look at these numbers, you may ask, why is the S&P 500 reporting earnings so great? Well, it has to do with stuff like technology. Have a look here, 88% beating EPS, 64% beating sales, 64% beating sales and EPS. At the same time, we look at stuff like healthcare, 88% EPS and sales beats. We look at discretionary, 74% EPS beats, 57% sales beats. And these bigger players are actually beating earnings, and that's what's lifting the entire index, because EPS is predicated on market cap weight. The bigger you are, bigger your earnings contribution is. These big boys are contributing a lot, stuff like Google, Amazon, Microsoft, and that's why we're seeing incredibly good earnings here in the S&P 500. However, companies that have been missing earnings have actually been punished more than usual. The average miss on both sales and EPS is coming in down 4% one day after reporting their earnings, which is well below the historical average right here, and is in line with times such as 2022, the third quarter, the first quarter of 2012. At the same time, you can actually see here that if companies are beating, they're actually below the average movement, which is just over 2% here. So, you miss, you're getting sold off more. If you beat, you're not getting as bullish a performance as you would expect. Now, let's actually look at comparables. So this is our quarter right here. This is what we've reported. This is blended earnings growth, and these are the earnings of all the previous quarters. Now, our comparable quarter is actually this quarter right here, the first quarter of 2023. We reported negative 3% growth here in the S&P 500. We also will have easy comps here in the second quarter. Then the third and fourth quarter is when comps get a little bit tougher. That being said, if stocks do continue to come under pressure, you do want to be a buyer this quarter, because earnings are coming in good. The fundamental picture is looking really good, and we actually have another quarter of easy comparables. In fact, 50% easier comparables before things get a little bit tougher in the third and fourth quarters. Now let's actually move on talk a bit about the economy, guys. So I went over the GDP data again, and I found some very, very interesting data. So this is GDP growth excluding net exports and inventories. Now, why do we leave out exports and inventories? It's very, very simple, because they average to zero over the long term. So if you want to find the underlying growth, you stick to the other components, right? And if you remove this right here, in the most recent GDP report, the March 2024 report, we actually get just under 3%, 2.8, 2.9% growth in GDP. And GDP was actually quite healthy in Q1. It was mostly due to volatile inventories and exports. That's why it came in low. But if you actually look at stuff like business consumption, non-residential investment, residential investment, housing investment, they were all strong. It was just exports and inventories that were a real drag on this GDP print. So all in all, the GDP print at 1.6% looks soft, but if you actually adjust for this right here, which you normally should, the print actually came in very, very strong. And that's actually part of the reason why the market was so resilient on Friday, and why it probably will remain resilient, especially if earnings hold up the way we think they are. Now, Goldman Sachs have also come out and revised their GDP figures. You can see here's the 1% in Q1 2024, and they are expecting 2.9% growth here in the second quarter, 2.7% in the third quarter, 2.4% in the fourth quarter 2024. So that's GDP. Let's actually talk about inflation. So inflation is remaining sticky. We saw that with the PCE report. We saw that with the CPI report. A lot of it actually has to do with just consumer spending. Real personal consumption expenditures remains above this trend line right here. At the same time, disposable income compensation growth continues to outpace inflation. You can see a 3-month, 6-month, 1-year annualized PCE inflation. So we do know it's 3-month 4.4% annualized. Employee compensation outpacing inflation. Same here with disposable income. And this is true for pretty much every annualized period. And it would be terribly concerning if disposable income and employee compensation was actually below the PCE inflation mark. That would be the early signals that we are in very early stages of stagflation. However, consumption is the reason inflation is remaining sticky, particularly services like wages. But this consumption data pretty much tells us that the consumer remains very strong, and the GDP data tells us that too. Cyclical components of GDP were very robust, as we discussed earlier. The real reason as to why inflation is remaining sticky has to do with stuff like insurance, among other things. Now, according to Goldman Sachs, car insurance prices have contributed 0.8% year-over-year growth to core CPI, as you can see right here and right here. However, they expect premium increases to slow significantly for the rest of 2024, as you can see right here, bringing the contribution from car insurance to a year-over-year core CPI down 0.4 to 0.5% by December 2024. We should see a tangible decrease in car insurance, coupled with the data I showed you on Friday or Thursday. With the shelter data, we should actually see shelter decrease as well. And we should actually see continued disinflation in PCE CPI, assuming we don't get any major spikes in other sectors of the economy. Guys, looking at gamma, so big changes here. So a lot of negative gamma has rolled off the tape. We are officially in a new month. So Vanna and Charm flows are going to come back in a big way, and they're going to start supporting the market here in the first week, starting on Wednesday, in the second week into expiration into this OPEX week. And we can definitely see that with what we've seen in the tape. We've seen a lot of negative gamma leave the tape in this window of weakness. We've seen quite a bit of positive gamma come in. That being said, we are still in elevated levels of negative gamma. There is more negative gamma in the tape. However, with the put support being at 5,000 and the call gamma being at 5100 and 5065 being the gamma's flip zone, as long as we're probably above this 5,000 level, I would say that risk is skewed to the upside and you want to buy dips, sell rips all the way to 5100, unless we actually go ahead and test this 5,000 level aggressively and have price discovery below it. But you know, this 5,000 level, 5020 level, I buy dips, sell rips all day to 5100, and even look to maybe this 5200 strike. We should see this strike build out more as we move into April OPEX. Now guys, I just want to look at some key charts. You know, we look at these every single week, the longer term risk on risk off indicator, and we did pull back in a substantial way after this 4 to 5% peak to trough drawdown here in the S&P 500, but we bounced off at the zero line, and that means we are still in a risk on environment. And this right here, a dip buying opportunity. We saw the very same thing with the risk on risk off ratio right here. We do know that resistance turned to support. We saw that right here, and we actually went to go make a new all-time high with the risk on indicators versus the risk off indicators. At the same time, if we look at the RORO risk on risk off risk range summary right here, it just looks at risk on instruments against risk off instruments. Now do take this with a grain of salt because they have like small caps here as risk on against large cap. But let's be real, large caps are super risk on. If you look at like technology, semiconductors, right? In aggregate, we look at these as risk on, risk off, and we can see this is the average right here. And generally speaking, guys, the sentiment is still risk on, and any pullbacks we do get in this market, we do want to look at these as dip buying opportunities until we see material changes in stuff like this moving into the risk off section, or if we see a tangible breakdown in these two charts. Now guys, I just got a couple of charts here for you guys this week. This is the 2012 analog. It's probably the most comparable year to what's happening right now. Now I do know it's just 1 year of data. However, we could still look at it to see what did happen in years like this. 2012 was an election year. We had a strong run up in this election year and then a sharp pullback around this April period into July. Now this analog points to a 4,700, 4,800 low here in late July, and you can actually see that we do normally get a bit of a relief rally with which what we're seeing right now, and then we get a second wave lower into this 47, 4,800 area right here. So if we actually do like continue a little bit up here and then move down lower, that would be normal in comparison to this 2012 analog, but all in all, it should just be looked at as a dip buying opportunity because we normally do go higher, made higher highs relative to the high we put right here in 2012, and we actually went on a very, very strong rally. We did pull back a little bit here towards the September, October area, and then, continued higher in November and December. So if we do get a little bit more volatility, that would kind of be normal, but I would take this reading with a little grain of salt. There's just not enough data there for us to take anything concrete. However, it's still good to look at regardless. Something else we could look at, this is the Nasdaq cycle composite for 2024. Now, this composite right here places equal weight on the 1-year seasonal chart of the Nasdaq, the 4-year presidential cycle, and the 10-year decennial cycle. And this is what we're doing right now. This blue line is actually the composite cycle. And you can see we normally have a strong run up in the Nasdaq, which is what we've done right now. And then we do normally pull back quite significantly here in this May, June period, April period. I guess you could say March, April, May, June period, this 4-month period. And that's actually what we are seeing. We normally then put in a low and then we do travel higher for the rest of the year. However, that's not without volatility in this period right here. We actually do go ahead and put in a double bottom, and this is actually the best place to enter longs in October for what is a spectacular rally. And you can normally see we go from about down 8% all the way to up 7%, and that is a 15, 16, 17 percentage point swing from the lows to the highs. And if the Nasdaq does continue to pull back, we should look at the May, June area as the first pullback opportunity to add. You always want to add on the first position because normally we can actually pull back to the double lows, but sometimes in bull markets as strong as these, we don't ever get there and then we just continue the rally upward. That being said, this is the composite cycle there for you guys to see, for you guys to use, and it does point to lower price action here in the Nasdaq with quite a lot of volatility for the rest of the year. Looking at gold, this is short-term impacts of various geopolitical events on gold prices. This is what happened on the Hamas attacks, the Iraq invasion, 9/11, the Gulf War, Russian invasion of Ukraine. This is what we're doing when Iran attacked Israel. And you can see that gold has actually traded a bit lower, but it did trade quite significantly up into this event. So maybe gold did send a warning. However, based on history, when we do have these geopolitical events, gold is actually a really good diversifier of wealth. And we could see returns upward of 13, 14%, 6% in a very short 3-month period. And that normally would outperform equities in such a scenario. Now guys, data in the week ahead, the big focus will be on the FOMC rate decision, non-farm payrolls, ISM manufacturing. So the rate decision for FOMC is expected to be left unchanged. What's going to be important is Powell's comments, but let's actually talk about non-farm. So we're going to look at the consensus estimates. Change in non-farm's payrolls, 250K is what the market is expecting. 200,000 private payrolls, a 3.8% unemployment rate, average hourly earnings month over month at 0.3%, average weekly hours 34.4. These are the expectations. And then we look at global services PMI, ISM Services PMI, both expected to be 50.9, 52.9, both above 50, which is expansion, and this should support industrial stocks and stocks as a whole if these do come in line or better, and if payrolls do come in line or better. Guys, a lot is dependent on this labor market right now. If we do see very weak payroll numbers, that is gonna not be good for equities, particularly with the GDP print we got and the PCE print we got last week. So we do want to see strong numbers right here. Otherwise, we can see short-term pressure, short-term weakness in equities. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.